which was one at program. Truthfully, I absolutely love it because it's a way for us to give back to the public and help you in any way that we can. So our purpose is to serve your needs. We provide you information on how to records, you know, what's important. Today, I'm just going to give you a bit of information on our program itself, and then we do have some common errors to go over. Just so you know, in your package here, you do have what we call the Liaison Officer Kit. It is not going to follow this at all. It's just some additional information for you, and it does have the information on it with regards to the common errors.
Well, we acknowledge that we are the land of the Anishinaabe. Thank you.
Thank you.
And maybe Mo, you'd like to introduce yourself too, so people know who you are.
Oh, sure. So
Might as well.
I'm when I'm responsible for this. But I do not have the knowledge that Erin has, and I'm actually attending the session. I started with the program a year ago, so
Okay.
this is a good chance for me to learn a little bit too.
Yeah, exactly. And maybe what I'll do is I'll take this opportunity also to introduce our staff so everybody knows who's here.
Okay.
So we have two staff here aside from myself. I'm Grace Shane, the manager of the One Hub program. Caius is with our is also with One Hub, and he's our financial literacy coordinator. And Samaya is our business development advisor. So we're all involved in this program.
Okay, excellent. So the other participants, do you have businesses right now? Or are you looking to start one?
For me, can I speak of stuff? Yes. No, I'm not like I'm hesitating. That's why I want to learn more. So I like I want to start everything and I'm just before I did mistake.
Yes, I understand.
Yeah, for COVID, I was planning to export. I have products and markets 9 for NAFTA, based on NAFTA.
Okay,
But COVID hit and then all the plans fell apart. But I had all information for tariffs, but I didn't have any accounting information.
oh, okay.
Yeah, so because everything closed, I was supposed to go to some trade shows and get the business started. And ideally targeting countries with Canada with no tariffs. But if I have this information, I asked a couple of people about this, they just you know, especially when you're exporting, you know, and
Yes.
And I called, I think CRA line 2, they said that it's zero tax, but you have to pay it upfront, but then you get paid back. But I don't know how all this thing works. Plus, I have some crypto investments, and currently, like I have a lot of us fighting whether the crypto should be declared a security or a commodity. So if it's declared a commodity, I would be but I have to like structure it in a business. So I have a lot of knowledge. I want to have some knowledge before I go to them that what is the ideal, you know, you should have an LLC or a corporation, because the US side of the house has too much information, the Canada side I don't get.
And that your investments are all in crypto or all down in the US?
Yeah, crypto right now is you know, not regulated, so there's a very big risk reward.
Yes, I've
So
heard that.
There are some utility tokens, like 90% of the market is scrap, but there are some utility tokens which can go very big. But right now, the US Congress, there's a big power struggle between JP Morgan, the big banks, And because they want to regulate it the way that the common retail investors sit down. So I'm not an accredited investor. So I took the risk because it's too high a reward with less risk. So either I lose everything, which is not much in the crypto scheme. But if the regulations are, if there's a regulatory cap, right now there's a regulatory capture by the big banks in the US because they are running politics. So if they are kind of somehow able to, because this is a worldwide asset, you can buy this from Singapore, you can buy it many products in Hong Kong, Singapore, everything's buying stuff. So they can really make it local, they should be a global policy. So if I hit the jackpot, then I will use this information.
Well, I'm gonna tell you, we don't have any information on cryptocurrency in this.
So the structure.
Oh, the structure, okay. So, just so you know, the information that we're providing you today is all under copyright by Canada Revenue Agency. So, are not allowed to reproduce any of the information that we can provide to you. And the information we also provide to you today is good as of today. We always do suggest that you refer to our website for the most recent information. So our objectives for today is to give you an overview of the Liaison Officer service, an awareness on the common errors and mistakes, and then I am going to give a demonstration of some of our online tools, and then again, you can ask your questions. But as I said, for the new people who just joined us, if you have questions throughout, just ask your questions. So in Canada, as taxpayers, we all have a bill of rights. There's a total of 16 rights, and not only does it kind of outline what your obligations are, but it also outlines what our obligations to you are. So you're always going to receive professional, timely, and accurate information. One of the ones I love is the fact that we are looking for you to pay the right amount of tax. Not any more, not any less, just the right amount. The amount that is based on your information. The in your package, there is a copy of the Bill of Rights. So you've got them all outlined for you. So, back in 2000, actually it was 2014 when it started as a pilot project, and it was received so well that it became a program in 2016. And what we offer is either a one-on-one visit. Those visits can be done either in person, by phone, or we use MS Teams, so a video conference. We also do seminars, kind of like this, where we go out and we speak to groups. So what our objective is to provide you with an understanding of what your tax obligations are and your rights are. Again, you will receive timely and accurate information. You will receive free support and guidance. And we do provide you a lot of information on common errors or mistakes, and also ways that they happen so you can avoid them. So as I said, we've got either a personalized visit, which is one-on-one, or the group seminar or webinars. So in either the visit or the seminar webinar, what you can expect is to get a better understanding of your rights and tax obligations and the possible deductions that you're eligible to. We do go over bookkeeping concepts and best practices and the ways to avoid errors. And part of that is because we want you to get it right from the start. There's no point in you keeping your records for 5 years and then 5 years in, you realize that you've been doing something wrong all along. We also go over some helpful tools, so and our electronic services, and discuss financial benchmarking, which is, it's a great tool because what it does is it gives you a kind of an overview of what businesses in the same industry as you, what their expenses are, and where they lie in comparison to the income they're earning. And then, of course, we'll answer any questions or tax-related issues. So we are able to do a bookkeeping consultation with you if it's an in-person visit. And what that is simply we kind of do a quick review of your books and records. And what we're looking for is just to ensure that any income that you have gets entered into your books and records, so it'll eventually go to your return. The same with your any deduction. So if we came out and it seemed like there is actually an expense that you could probably have, but we don't see it being claimed, we would ask you about that. Because that's something that you're missing. You can keep your books and records anyway, as long as they're complete. So we don't make any recommendations. But if you want to use one of the bookkeeping programs, you're quite welcome to. But if you're old school and you want to keep them in a ledger book, that's fine as well. As long as they're complete, that's all that matters. So as well, when we're doing this review, if we see errors within your books, we can discuss that with you, why it might have happened, where things kind of went wrong, so it doesn't happen again. And then, of course, we will provide you with information on correcting those errors. Now, one thing about our program is that it is completely confidential. So I could come out to your home and I could see that, wow, there's $50,000 worth of income that you didn't report. I'm not going to go back and say, well, Joe Smith, they're not reporting all their income. What I'm going to do is I'm going to say to you, hey, this income is missing. You really should correct your return. And then it's up to you to do that correction. So the benefits to you in having a good set of books and records is that it makes completing your taxes much easier, as well as trying to determine what you may owe. If you are looking to get a bank loan or, a loan from other lenders, they will require you to have a good set of books and records before you get a loan. So if you already have that, it makes the process so much easier. And then, of course, the one thing that you always want to know is where your business stands right now. So if your books and records are up to date, then you're always going to be able to look at them and say, okay, I know where I am. I know that I've already made this profit. So that's something that you want to know to either like to determine where your business is going to go from here. So the common errors, of course, one that we see is unreported or underreported income. Quite often where that will happen is, for instance, if you've got, you're operating two businesses. So I have a main business that I run all year long. And then in the summertime, all I do, I also have another side business where I cut lawns. Well, when it comes to the end of the year, sometimes what happens is all you're focusing on is that main business, and you forget to report that secondary income. One of the other issues that we have are what some people will do is to determine their income that they've earned, they'll look to their bank deposit, which is all well and good as long as all the income you are earning goes into the bank. But as we all know, and if you've got an expense or you need to make a purchase, you'll use that cash. So if you're using deposits to determine what your overall income is, it's going to be underreported because you're not getting those cash sales income in it. When it comes to overclaimed expenses, where we see the most errors are related to expenses that have both a business and a personal component to it. So those are things like your business use of vehicle, business use of home, meals and entertainment. The other ones that we see are utilities expense. And that can be confusing because utilities kind of come up in two places on the return. So, and then the capital cost allowance, which can be an intimidating process. Okay, so within your business, when you've got expenses, you're going to have current expenses and capital expenses. So your current expenses are those that get consumed rather quickly. They get consumed within the year. A capital expense it's an asset that is going to provide you a benefit over a long term. So in accounting, there's a matching principle. You match your income and your expenses. So with a capital, with the capital cost allowance, what that does is it spreads out the cost of that asset over time. So it's spread out to the different income you're earning each year.
I have a question, like,
Yes.
the previous one, you said like, is a home as a business, or is not, this one is not allowed, right? Or
So no, you can operate your business from your home.
Uh-huh.
It's just that you can't claim 100% of your home expenses. You have to determine the portion that's being used by your business.
so how about that for the internet, for example, the internet is like, it's the expense of the internet.
Yes.
So that's one is that is for the home of the for the company.
So internet and phone are always the big ones. Because typically with your home office, what you're doing is you're taking the size of your office. So it's 100 square feet. Your total home is 1,000 square feet. You're using 10%. So 10% of your heat, hydro, property tax, insurance, you'll be able to claim against your business. But your phone and internet, if you've got 10% use of your home, the likelihood that you're using a lot more than 10% of your internet, it's pretty good. So we don't have a method by which you have to determine that percentage. You have to determine what is reasonable in your situation. So, for instance, if you're alone, if you're single and you're living alone, then, and because you're on the computer all day and internet all day long, at the end of the day, you really don't want to do anything personally on that, your percentage of use might be higher. You're going to have to still allot something to the personal use, but it might only be, for instance, let's say 10%. Now, if you're married and you have children, especially if they're teenagers, they're going to be on the internet all the time. So you have to take that into account in determining what portion is going to be allowed to the business. Okay. So we talked about the secondary or other sources of income and those cash sales. One way that you can avoid those is by doing bank reconciliations. So essentially, you get your bank statement every month, and you're going to compare that to what your books say. So you're going to make sure that any deposits to the bank are recorded in your books, and if you have a cash sale, that's going to be a discrepancy there. That's why the two are going to be a little different. But you're going to look at all the different aspects, both the revenue going in and the expenses going out, and determine if there's any errors. Because sometimes what can happen easily is that you just transpose numbers. So, and then of course we talked about claiming the personal portion. So where we find a lot of errors in regards to expenses is that person just doesn't have the documentation to support the expense that they've claimed. And with us, you want to document. You can never have enough paper. So for every purchase that you make, you want a receipt of some kind.
I think it's usually with uses. Last time when I bought receipts for warranty, after a while the store is used.
Yes, so that does happen. So what we suggest is if you do have any receipts that fade, usually it's those receipts that are on like a thermal paper. We suggest you either scan or photocopy them. Now, even though on your receipt, you might not be able to read what it says anymore, you still have to keep that receipt. Okay, so just staple it to the photocopy. Oh, you're welcome. And then of course, when you are looking at expenses that have both the business and personal use, you're going to be determining what that percentage is. There has to be some reasonability behind it. So if I say, well, I use my car all the time, so I don't know, I probably use it 90% of the time for my business. That won't cut it. you need some concrete explanation as how you made that determination. And then, of course, sometimes it just comes down to the fact that you don't know the tax rules that's related to that particular expense. Where we see that a lot is with the capital cost allowance and meals and entertainment. Only because with meals and entertainment, there's limits to what you can claim.
So for the car, if you have a car loan, say if I am exporting, so I'm buying, say, X amount of stuff from Costco, I go to Costco, I say, okay, I keep a log. This was my mileage of the car, this is the mileage and I clean that.
Yep.
I don't know, like, how much gas I have no idea.
So,
So do you keep the gas and the mileage?
yes. So we're going to get into further details of it in just a minute. So if you don't mind holding off on that. So business use of home, to actually be able to claim business use of home, it either has to be one, your place where you, the principal place that you operate your business from. So for instance, if I'm a contractor, most of my work is going to be done at people's homes. But where I actually run my business from, I do my invoices, my estimates, all that type of thing, that's from my home. So that's going to be, I'll be able to claim business use of home for the office. The other one is that you either have to, the space that you're using is where you're earning your business income, and that's where you generally meet your customers, clients, patients. So I'm a real estate agent and I have an office at home. And sometimes I write up contracts at home. But I also work out of a brokerage firm where I pay a desk fee, and I never see clients at my home. They always come in, see me in the office, or I go meet them out in the field. So because of that, because I have an office somewhere else, I cannot claim business use of home. Okay.
Office, like you have a home office, but like say your dining room is being used, initially for your dining needs
And your office.
then you cannot, right?
So there's additional proportioning that you have to do. Okay, which we'll get into. Okay.
Are you ahead of me?
Yeah. So your allowable expenses, your heat, hydro, basically any utilities, maintenance costs, property taxes, home insurance. If you have a mortgage, the mortgage interest, you're renting the rent, and claim capital cost allowance, although be very cautious with that. And that's because your home is the only asset that you can own and sell and have a gain on, but that gain is not taxable. However, if you start depreciating, so essentially what happens is when you're claiming capital cost allowance, you start out with something say it has a value of $1,000, and you depreciate it for a few years. Now on the books, it's only worth $500. Well, if I sell it and I sold it for $700, I would have to report income of $200 because I've depreciated it less. So do you really want to do that to your home? Because now that gain that you earned is not fully non-taxable. Some of that is you're going to have to claim a capital gain. So your allowable portion, you're looking at your workspace compared to the total area of your home. And so for situations where you're using space that is also being used personally, you're going to also look at how many hours in a day is it being used for business and how many days of the week. So,
So it's the use, it's not the area. For example, if I have a room that is dedicated for my business. Can I just claim that room regardless?
yes, if that room is being used exclusively
Yeah,
for the business, then you're going to do
portion,
the portion. So you're gonna just determine how big that room is,
yes.
compare it to the total size of your home. Okay. So here we go. In this instance, the total expenses for the year are $13,000, and there's $331 in GST HST. So one thing you do want to watch is if you do end up with your business having a GST HST account, not all expenses have HST on them. So that's something you have to consider. You can't just do a blanket, I'm going to take 13% of all of my expenses. So in this instance, the total house is 1,800 square feet, the office is 180. So 10% is used business, 90% personal. So that's going to give me $1,300 as an expense. However, because it's 10%, to claim an input tax credit or an ITC, you have to use it more than 10% of the time. So because this is right at 10, you don't get an ITC. Now here's the example for you. So you're using the space. So it's determined that they're using the space only 7 hours a day out of 24, and they're using it 5 out of 7 days. So that ends up breaking down to now what you're claiming is $271. So you're taking the 1,300, multiplying it by 7 over 24, multiplying it by 5 over 7. Okay. Did anyone have any questions? Any other questions about useful?
Yeah, so about the home expenses, usually years in a row, I accounted that's a limit of 20% of usage, because I'm basically working at home and it's 1-bedroom apartment and that's what I do my business.
Okay.
But I don't know how and why you set that limit of 20%. Is it maybe according to my expenses and the square feet, etc.? But is there any legal limit or it's just proportionally?
It's based on the percentage of use of your home. So it's possible that when you look at your apartment, the bedroom takes up 40%.
Yeah.
50% of the time you're using it personally, 50% of the time you're using it for business, that brings it down to 20%. There should be some calculation behind it, because if you're ever selected for a review or an audit, they're going to ask you how that percentage was determined. Generally, with those as well, unless you move or you change where you're working within the house, you calculate that once, you write it down on a piece of paper, how you determined it, and you keep that with your current records. Because you're likely, once you are calculate that, you may not get selected for a review or an audit for 5 or 10 years. Well, 10 years down the road, I'll be lucky if I remember my name some days. So you're never going to remember how that calculation was done. But if you've got that piece of paper in your current records, simple to explain. So with your motor vehicle, if you have a place of business away from your home, the travel from your home to that place of business is considered personal. It's no different than you driving to work for a T4 employment. However, what you can claim if you're working from home is the distance between two places of business. So if you do have more than one place of business, as long as they're not related, you can claim those distances. You can claim the distance to meet a supplier, a client, to make purchases for your business, go to the bank, the post office, whatever is related to your business. So the best support for that is a logbook. And in your logbook, you're going to have the date, where you went, the reason, how far it was. Yeah, just those 4. So beginning of the year, you take so January 1st, you're going to take your odometer reading. December 31st, you're going to take your odometer reading again. That's going to give you the number of kilometers that you've traveled the entire year, both business and personal. Your logbook, you're then going to add up all the kilometers in your logbook, because all you're recording in there is your business travel. That's going to give you the business portion. So, we threw this in. So we'll get there in a minute. So with motor vehicles, there's actually 2 different types of vehicles. There's what we call a motor vehicle, and then there's a passenger vehicle. And the difference is that when it comes to passenger vehicles, there is a cap to what you can claim on your capital cost allowance. So, and I believe right now it's at $36,000. So you might go out and you might spend $50,000 on the car, except you can only depreciate up to $36,000.
That's a lot of money.
Yeah.
Good.
Yes, still. Now, with a motor vehicle, there is no cap. Because that's, and the difference there is your passenger vehicle is really, it's just used to get you from A to B to C kind of thing. A motor vehicle is one that you're using to transport either goods, equipment. It could even be employees. But there is a distinction. So you can claim either, so you can claim the capital cost allowance. That's how you're going to get the expense if you've purchased the vehicle. If you lease the vehicle, then you're going to claim the lease payments. Once again, with the passenger vehicle, if it's over the $36,000, there's going to be a cap to the amount of lease payments that you can claim. Of course, if you've taken out a loan, you can claim the interest on that. And then as well, you are entitled to claim an ITC. Sorry, an input tax credit, that's the GST, HST you paid on the purchase. And it's again going to be based on the percentage of the. So some of the eligible expenses, your license registration, the fuel, any maintenance costs, interest if you borrowed money, the insurance. And then your repairs and maintenance, I don't know if I said that already. And then either the leasing costs or the capital cost allowance. What you're not allowed to claim are traffic tickets. You get pulled over and you get ticketed, that's yours. That's a personal cost. And also, if you've had an accident during a personal trip, that you can't add into, that's kept out as well. So, in this instance, it's a leased vehicle. So, the expenses total $6,180, and there's $634 HST. When we do the proportions, so our logbook says we've driven 12,355 kilometers. Our odometer says in total we drove 20,592. So that ends up being 60%. So 60% of the time I'm in my vehicle, I'm using it for business. So I'm going to be able to claim 60% of the total cost. So I've got 3,708, and I also get to claim, because it's over 10%, I get to claim 60% of the HST as well. Now, where it comes to, if it's something that relates directly to the business, so for instance, sometimes when it comes to your insurance, if you're driving a lot for business, they will make you take out supplementary business insurance. Well, that amount relates strictly to your business, because if you didn't have the business, you wouldn't have that expense. So you don't have to proportion that. So the business insurance was $200, you get to claim the whole amount. And then if you've got parking fees directly related to the business, you get to claim those 100%. So then in total, this person would be entitled to claim $4,408. And then the $445 in HS. Now we get to the ugly one. Everyone loves this section. So, as I said before, your capital cost allowance is going to be for those assets that depreciate over and provide you with a long-term effect. And they will wear out over time as well. So again, we've got the current and capital expenses. The current expenses are typically something that recurs. So your utilities costs, office supplies, that type of thing. Excuse me. And for those, you can, if there's exclusively related to your business, you can claim 100% of those. So in this instance, they're saying that the person has a building. What they've done, it's a wooden building, and they've just repainted the building. So basically the building is exactly as it was before, just a fresh coat of paint. So that's considered to be a current expense. It's going to have to be done at some point again. So you would be able to claim 100% of the cost of painting. Now, on the other hand, if it's a capital expense, so those are assets that give you a long-term benefit. And you're going to spread that cost over several years. So with that same building, if instead of painting it, I decided that I was gonna put vinyl siding on it, I have actually improved the building. So because I've improved the building, the cost of that siding gets added to the asset. And that's how you would get it through. You would claim it through the asset through capital cost limits. So some of the most typical ones that we see, class 1 is for business, or sorry, buildings. So this is the class. This is the portion that you get to claim. The most typical ones that we see are class 8, 10 or 10.1, 12 and 50. So 10 and 10.1, 10 is your passenger vehicle or your motor vehicle. 10.1 are those passenger vehicles that actually had a value of greater than $36,000. In class 8, that's pretty much anything that doesn't get encompassed by another class. And class 12 is, that's where a lot of your tools, your small tools, equipment, that type of thing, where it has a value of less than $500. So when it has a value of less than $500, then you can actually expense it in full the year of purchase. And then 50 is your computer equipment, your laptop, computer, printer, that type of thing. And they depreciate at 55% in general.
Home office, I think home office to get some contractors to renovate, then it kind of is seasonal. Would it transfer on the season?
So what are you renovating?
Say you got a new cabinet that just to find stuff for you.
Okay, so if you've have a cabinet made for your office, then that is specific to your business. Okay. So it would be the same as if you went like, but maybe you've had to have it built because of the space it has to go into. Where you do have to be careful is, like I said, is with your home and any improvements that you make to your home. So for instance, you decide you're going to put a new kitchen in this year. Well, the kitchen has nothing to do with your business, so you can't include any of that cost into your business. If, however, you had a contractor come in and completely repaint the entire home, including the office, you would be able to claim a portion of that.
Washroom.
The washroom would be included in personal. Yeah. Now, it generally is your office space. Sometimes, depending on what your business is, you have an office in the house, but you also have space out in the garage. So you're either storing equipment there or you do work out there. So then that space also becomes part of the house. So your house is 1,000 square feet. The garage is 500. So now you have 1,500 square feet. And then you determine what portion of the garage that you use.
So there's suppose you're exporting and you kind of use your basement unfinished part for storing stuff before they're shipped. So would it apply, the garage to apply to your basement unfinished basement?
So basements actually get added into the total. It's not like in real estate where in real estate, they look at your main floor and anything above the ground. They don't generally count the square footage of the basement. So in this respect, if you've got a basement and a first floor and each floor is 1,000 square feet, you have 2,000 square feet. But you would be able to claim a portion of the space that you're storing, just has to be reasonable. You can't say I'm using the entire space if you're only using this much storage space. Okay. So in this example, person's bought a computer, so it's class 50. They get to depreciate it 55% a year, and they're using it 75% of the time for their business. So they've applied the 75% to the 2,000 to get the 1,500. The general rules of capital cost allowance is that in the first year of purchase, you can only claim half of the allowable capital cost allowance. So it's the 1,500 times 55% times half. So in the first year, you'd be claiming $413, but in the second year, you don't have that half year rule. So in the second year, you're claiming 598.
So you are not actually claiming the full 27.
I'm going forward. Yes, okay, thank you. So currently, we have a couple of new ways for capital cost allowance. So they have brought in the accelerated incentive method, which is a method that was brought in to generate sales. And so what, thank you. And so what they've done is they've gotten rid of the half year rule. And they said, in the first year that you purchase, you get to increase the value of that item by 50%. So in the first year for that same computer, you would be able to claim $1,237.50. And because you're claiming heavy in the front, then the next year you've got $144.37.
So is it by choice or is it regulated?
This is what they're expecting you to use right now.
Okay.
We also have another one, which is allowing you to claim certain classes 100% upfront right now. So meals and entertainment. So like everything, the expenses that you can claim are those that you incurred to earn business income. So when it comes to meals, that includes the meal itself, beverages, tips, and but it's for those times that you are having a meal with a client or a supplier, or you've gone to a convention or training. If you're just traveling throughout your day and you stop for lunch, that's considered a personal expense. When it comes to entertainment costs, those are, tickets for the theater, concert, a sporting event, the cost of a private box. It doesn't include annual fees. And you can't claim anything related to golf. I don't know why. Somebody decided that, no.
Some of the best deals were done on the golf course. Jeez.
I know. Because somebody didn't like golf.
Oh, obviously.
So when it comes
That's funny.
to your meals and entertainment, so you're taking a client of what you're allowed to claim is 50% of the bill. Because the other 50% that you can't claim is considered to be your personal portion. You have to eat, so you can't write that off against your business.
But it's still business, no? Like, I mean, if I'm not going to see that person or to meet a client or a supplier, I would just cook at my place and would not spend that money in a fancy restaurant.
Right, except you still have to eat. So I don't make the rules, I just tell you what they are.
I didn't know how.
Yes. Now, it does say it's like the lesser of. So 50% of the lesser of the actual cost or an amount that is reasonable. So for instance, you might say, well, I only had a salad, they had a steak. I'm going to take 50% of that, except it's the lesser of. So it's going to be 50% of the entire meal. Where that does not apply is if your business is regularly providing food or beverages to people, so you own a restaurant or if you've got employees, you are allowed to take your employees out up to 6 times a year, and you can claim 100% of that expense. The only restriction is that if I have 6 people who work in my office, 4 of them are my good friends, I can't just ask the 4. I have to invite everyone. They don't all have to, they all don't have to go, but they all have to be invited. For any meals, you need the receipt again. What should be on the receipt is the name of the customer, purpose, and what's the other one? Oh, and their contact information. Yes. Yes.
The employer's number.
So if I take Joe Smith out to dinner, on the receipt that I get, I'm gonna write on it Joe Smith, their phone number, and the reason we were meeting.
Yeah.
You're right. You're right.
Yes,
You have
yes.
the restaurant.
Just write it on the back.
Yeah.
Because what's gonna happen is if you ever are asked about it, it never happens right after the event.
Yeah, of course.
It's always gonna happen years
5
down the
years
road,
later.
and you're never gonna remember what
No.
that one was. But if you've got it written on the back, it's hard to say, well, how this is not a business expense. You've got your customer's name on there. It can be tied back possibly to an invoice. Even if they ended up not purchasing with you, you're gonna have some kind of other records that you were talking to them about a certain deal.
Excuse me, about the 50% rule, is it like 50% no matter the number of tourists provided, or it's proportion? Because you said 50 because they should eat my portion and the other person, but if I'm inviting, I don't know, let's say the client and their employees and they're 5 or 6, and I'm inviting everyone for dinner, is it still 50% or it's? How does it work?
I'm gonna have to check on that. I would say because generally, if it's a, if you're discussing business, you generally wouldn't invite their employees. However, you might be able to get away with saying it's one of those 6 times a year thing, but I'll look into it and I'll get the answer back to Grace.
Okay.
Okay?
Also, when they honest, like, the square footage is the India one, how much square footage of your home you use for your business, it's like. So, what's the, the priority, because Leos is not that big deal, like, I would think that way, but like, what's their, key points on which they actually come and strike, okay, let's see these 2 things, and if there's a discrepancy, then they go deep. I don't know what's the.
So generally what they're going to look at is what your revenue is and what that expense is. And is it reasonable based on your income?
But I do find
So
it,
they may or may not ask you about it. Okay.
how much they build down depends on how much.
So if you have, let's say you earn $10,000, I'm going to make it easy, $10,000, and you claim $500 in expenses, and you claimed $50 in meals and entertainment, they're not going to ask. Because it's not a material amount. Okay. They may go over, just make sure that when you're claiming it, you're only claiming 50%. But the likelihood that they actually look into it is pretty negligible. So telephone and utilities, we talked about this before. You're going to be claiming the portion that you use to earn business income. And once again, it's up to you to determine what that reasonable basis is. So for your internet, for instance, you may say, okay, in a day, this is how much I'm on it for business. So I'm going to take that portion. For your phone, you could look at the calls and like if you've only got one phone and determine what calls were business and what calls were personal and determine what that percentage is. But it's up to you to make that determination. Of course, if you have any phone calls that are long distance, don't even exist anymore, with cell phones, you are able to claim that 100%. Okay. So utilities, that comes in where, so on the statement of business activities that you're going to complete, there is a section within that for business use of home, where you're going to claim your utilities. But then in the list of expenses, there's also utilities again. That's where you have another place of business, somewhere outside of your home. That's where you would put both, because you're going to be claiming 100% of business. And just like your home, it's going to be your gas, heating, electricity, and water. Typical. So some,
Water, because in your home office, water is more for your kitchen and for all you drink it.
yes, but you can come up with some. When we let you have something, don't worry. So just some other general expenses, clothing and uniforms. If you have, any kind of safety equipment or a uniform that you wear for work, you can claim that as, a deductible expense. You're also able to claim, any cleaning costs if they're related to that as well. Things you can't claim are business suits, your dresses, things that you could wear both for business and personal. You can't claim any of that. Conventions, you're allowed to go to 2 conventions in a year. And the convention has to be related to your business or professional activity. And it should be held by either another business or an organization that is also in that same business, but in your geographical area. So what can happen is the industry that you're in, there's only one organization that you can join, and it's a national organization. So for that, the geographical area now becomes Canada. So if this year, they might hold a convention in Toronto, but next year they hold one in Vancouver.
Yeah.
So they're not going to say, well, you can't go out to Vancouver. Now, if it was an organization that held one in Toronto and another one in Vancouver, the same conference, and you just chose to go out to Vancouver because you thought, well, I can take my family along, we can get a bit of vacation out of it, then it's possible you could be limited on what you can claim.
So basically, you're saying that conventions or big conferences that I attend outside of Canada will not be deductible as these like expenses?
No, because there are some groups that are international. So they hold conferences down in the States. So if that's where the conference is that year, you're allowed to go. It's where there is 2 sessions of the same conference that are happening. They just do one in the East and one in the West. So you'll be asked, well, why didn't you go to the one in the East, which is much closer, less expensive? You'll have to have a really good reason for not going to that one rather than the one out West. It's just that, and even if you don't, you'll be allowed to claim some of the cost, but they could limit the amount that you're able to claim.
So I go, like, say, I go to Hong Kong for Asia, and I just use my card, so I fly there, I stay in a hotel 3 days, 4 days, and then maybe just move around the city 2 days and come back. Can I, because it's a paid show, every country has a, like, these business chapters have different paid shows, different things. Can I claim that?
So
It's not a convention.
So if you're going to a trade show and the trade show lasts 2 days and you stay for 5, you can claim 2 days.
But the ticket,
You can claim the ticket.
prorated or you can?
No, you claim the ticket because whether you stay for 2 days or 5, you're gonna have to pay there and back. But your hotel, and your meals, that type of thing, you're only gonna be able to claim for those 2 days where the
Yeah.
trade show is actually happening. Okay,
It works the same for normal business trips, like you go outside of Canada to see the client that you want to go, or a supplier to know, so you have to do that under a business trip.
Mhm.
Yeah, so it's not only convention, I mean.
yes, yeah. And that really depends on the type of industry you're in. Right, there's some industries that are very exclusive, so that your customers are all over the world. So then there's an expectation that that is going to be a cost that you would incur. Okay,
So suppose like I call a shipping person in Canada, and that person, the ports are mostly Vancouver from here, the seaports. And then for the first time, you may enter into exclusive contract and you may have to fly for your supply chain. Because you don't want it to be disrupted, so that you can include the flight, right? For the business, if you're doing.
if it's tied strictly to the business, then yes, you would be able to. Just with any of these kind of one-off expenses, just make sure that you're keeping a lot of detailed information. So, like for a trade show, you want to keep their brochure or their invitation. If you're, you might keep the emails between you and the organization. So you want to keep enough information that's going to back up the fact that it was a business trip.
What about the car? Like if you enter, like suppose you're exporting, you don't want the person, you'll get some rebate because you're going to buy volume. And then you're opening a market for that particular supplier. And you are the middle person because you kind of had a portal and you are making that supply chain and making it possible. Because sometimes the people who actually manufacture don't have the time to look for additional markets. They may have the capacity to increase. So then if you go to a lawyer and make an exclusive contract with the supplier that, if this person is ordering this much from you, any order for next 10 years, even if they come directly to you because it's listed on your product, you cannot do direct business with them. You have to give me, even if you do direct business, you have to give me my cut, which would be 3%, 10%, 5%.
That would be in your contract with them.
So that you can deduct the law.
Yes. So, and of course, if you do go on a convention, and there really is nothing wrong. If you go on a convention and you decide, well, you know what, I'm going to take my family with me, but you're still going to limit what costs that apply only to you. So their flights, their meals, if you have to get a second hotel room, those are all personal costs.
So convention is not trade show, like if you are participating in trade shows, that's different.
That's different. Yes. Yeah. So travel expenses, so those are generally expenses that are something other than your vehicle. So airfare, train. It does include your hotel and your meals. Meals are still 50%. Yeah, you like that, don't you?
Because when I invite I'm in marketing, right?
Okay.
So I always have to see my clients, my partners, etc. And I always invite them, So meals is a big part for me.
Yeah. And then salaries. So where salaries get iffy is when you're hiring somebody that is not an arm's length. So if I am just hiring someone off the street, they've come in, they've applied for the job and I hire them, I don't know them at all, they're at arm's length from me. If I hire my son, he's not at arm's length. So that lawn business that I hire 4 people. I have 2 sons. I hire 2 of their friends. The friends I pay $20 an hour. My sons, I pay 30. Because I love them. Well, guess what? I can only claim 20. Um, I think it's 16 is the formal age, youngest age that you can legally hire.
It's gonna be changed, I think. Then Montreal changed to 12 and Ontario,
To 12?
Yeah.
Wow,
yeah, and now I think Ontario.
okay.
They hired 14. I don't know.
Yes.
So say your family is looking after books, you kind of teaching books and saying, okay, look after books, I like your job, child.
Okay, so if they're doing exactly the same job, then you can only claim the wage of the arm's length people. If your sons, though, have additional duties, so you can, excuse me, you can explain why they're earning more income because they have these additional duties and responsibilities, then you would be able to claim the difference. It's when they're doing the same job as anybody else, but getting paid different. So GST, HST errors, where we see a lot of them is failing to register when you should. There's a $30,000 threshold, so once you exceed that, you have to register. Once you're registered, revenue, gross revenue. Yeah. The either not collecting or not remitting the tax. And claiming the input tax credits where there's not the necessary or proper documentation. We do have what's called a quick method of accounting, but what some people basically in a quick thing is you charge the people 13% on your sales, but I might only report in 8.8%. But I don't get to claim any input tax credits because I've reduced the amount that I'm actually reporting. Well, what some people do is they say, I'll report that way. And they claim the reduced amount, but then they also claim the input tax credits. So charging the incorrect amount depending on the place of supply. So if all your sales are within Ontario, it's basically going to be 13% if it's taxable supply. But once you go outside of Ontario, that amount could change. So you just have to make sure that you're charging the right amount. And when you, this is where having good books and records comes in, is that what some people do is in their books and records. So I bought something for $100, so it was $113. They write in $113. And then they say, I claim $13 of an input tax credit. But when they add that 100, they don't just add $100 as an expense, they add the 113. So they're actually claiming that amount twice. And then for payroll, so whenever you have any kind of employee, it doesn't matter how much they work for you, they're an employee. One of the errors is not remitting the source deductions by the due date. At the end of the year, you issue a T4 to your employees. There's also a summary that you have to do, which keeps track of the payments that you've made throughout the year. So those two should balance. So sometimes they don't. And And then there are taxable benefits, and quite often we'll see that the taxable benefits are not included as income for others. One thing with employees, you have to know the difference between an employee and a self-employed individual. So it all depends on the facts of the situation. Generally, it comes down to, though, if I say to somebody, okay, I'm going to pay you $20 an hour, you have to show up here Monday to Friday, 9 to 5. You're going to use my equipment. I set down all the rules. That's an employee. If I hire somebody and they say for a specific job, and they say to me, okay, I'm going to charge you $500. I'll show up on Wednesday, may carry over to Thursday. That's more than likely a self-employed individual. So some of the online services we have, there's My Account, which relates strictly to your income tax, social insurance number, and My Business Account, strictly to your business. So that's going to be your GST, HST, payroll. If you're incorporated, corporate account, import, export. And what is nice about this is that you can do a lot of things now through this service as opposed to having to call in. So if you move or you change your phone number or there's any updates, you have to change your bank account information for direct deposits, you can go right online and make those updates yourself. In My Business Account, you can file your returns through there and make payments, a lot of different things. So My Payment, that's a service that you're actually using, it's tied to a card as opposed to your online banking. There are some payment arrangements that can be made through third parties. Often with those third parties, though, there is going to be some kind of a charge. Some of our other online services are mobile apps. We've got the Biz app, which gives you the majority of the information that you're going to be able to find on My Business Account. CRA business tax reminders. You can set up your reminders for making your payments, filing your returns, that type of thing. My Benefits CRA and My CRA, those are related to you as an individual. Our multimedia library has a ton of information. Business related, charities, just self-employed individuals. It has all kinds of information in it. There are podcasts, videos, can walk you through, like how to register for a GST account. Benchmarking, I talked quickly about. I'm not going to go into much here because I want to show it to you. And the Business Benefits Finder, which is another great tool. I'm going to show you that too. And then we just have some additional information on links to where you can go and numbers to call. I'm going to share this presentation with Grace, and so she'll send it out to you. And on the table, there's also this survey. If you don't mind taking just a couple of minutes to fill it out, we basically are looking for your opinion on us and the service. So, yeah. you think there's something we could have done better or should have done, let us know.
Question about the HST part.
Yes,
So, I will probably work with a supplier in Quebec, which will definitely charge the Quebec rate too. But will that be collectible at the end? Because you know how it works for HST, like what you pay and what you charge and what you pay, and then they do a deduction.
so for the QST, it's not part of GST HST. So if you have to pay that, then that becomes part of your expense.
Okay, so shall I claim it differently, like separately, not as a tax, right?
It's not a tax, no.
Okay.
So when you put it in your books, I think the QST is like 9.75 or something like that percent. So if you bought something for $100, you'd be paying $9.75. So when you record that expense in your books, rather than recording it at only $100, you're going to record it at $109.75.
Oh, okay, so basically I included in the.
You included in the, yes,
And I separate the edges.
yes. So this is the benchmarking. The link is in the kit and it will take you directly to this page. So it's just a matter of saying, create a report. And then it defaults to a few things. So it automatically defaults to $30,000 to $5 million. It defaults to Canada, but I generally would pick the province that you're in. As well, if you're a sole proprietor, I would select just unincorporated businesses. Only because corporations tend to skew the numbers a bit. So it gives you a better idea of what's happening in the industries that are comparable to you. We always do it based on total revenue and then percentage. And then you can either search the, excuse me, search for an industry based on, yeah, you're going to search the industry, and you can either do that as if you've got the NAICS code, which is the North American Industry Classification System, or you can use keywords. So this is lessons of residential building. It's not a good one. Okay, here we go. Residential building construction. You just have to highlight the item. And then you say, create the report. So it produces this. So what it's saying is that in this industry in Ontario, for just unincorporated businesses, there were 9,315. And I believe this information is 21. Yes, 2021. So what they do, then you've got your quartiles. There's bottom, lower, middle, upper middle, top. They've actually, what they've done is just divide that 9,315 in 4. So there's essentially the same number of businesses in each group. And whatever those people earn, that's what sets up the different ranges. So we're looking at 100% of the income. So, for so if I made, between 30,000 and 50,000, I would be looking at this first column here. So when it comes to my cost of sales, 16% of my sales is going to go to my cost of sales. So those are my direct expenses. So my materials or any direct labor. For the operating expenses, and they're, oh, they've expanded it. It's been a while since I've looked at it. So these are the only expense categories that they have. What's listed there, if it's, oops. Oh, come on now. If it's not listed in one of these, it just goes in other. So like meals and entertainment isn't here, automobile expense isn't there. That's all included in other expenses. So what you're able to do is actually compare your numbers with what the industry has. And to do that, it's just a matter of going to right here, add your data. You just go in there. And you start plugging your numbers in. Now, the only thing you have to remember is that these numbers are in thousands of dollars. So if you have $30,000 in sales, it's 30. And then you just fill in everything that you can. And when you'll use your tax return to do this, because that's where all your information is. And once you get everything in, down at the bottom, you'll just say continue. Another tip, don't hit enter anytime you're on this page, because it just kicks you out to the first page and then you have to go back in and do it all over again.
I didn't get the list.
Oh, it's in the package. Either tab or actually physically click between the numbers. The second page is really more related to corporations, so you can just go back and just say add my data. And then what's going to happen is it's going to put your information in the first column here.
When you start as a sole proprietor because you really don't know, it's more experimentation. Maybe 1 or 2 years your business will be tough. You need just 1 or 2 clients because these markets, some markets outside Canada are so huge that the products, if they're reasonably priced, they can move very fast. And per month they could move like a lot of products as compared to simply are less populated. So would you recommend initially go sole proprietor then corporation, or do you open a corporation and
We do not make recommendations for that. We suggest that you speak to an accountant and a lawyer, and they will guide you in the best ways. Some things to keep in mind are that some people think once they've incorporated, they have absolutely no liability. But if you're the sole shareholder and you're making all the business decisions, you are still liable. You can still be liable.
your house, your can all be
the other one, which I really like, is this benefits finder. So it's just made up of these drop-down boxes. So, and as you can see, you can either click on each one individually that you want. So let's say I'm just looking for funding and wage subsidies. I can just click those, or I can click all support and then say, okay. More specifically, I'm looking for up to $50,000, and my main goal is to start or buy a business. I'm located in Ontario. And I am in I'm gonna say forestry. And there we go. I have 2 employees. My annual revenue is up to basically $100,000. I'm not incorporated and I'm for profit. I'm Canadian and a woman. And I say, okay. And then finally, it says, it'll show you only the programs accepting clients or everything, even including those that aren't. I don't know who wants to see those. Because if they're not going to help me, I don't want to know. So I always use that. And then once you get this button here, see your results. It first gives you a summary of what you've entered. You have the choice of saving it. So neither one of these programs saves anything to that tool itself. It's going to save it only to your own system. So for funding, and it's probably going to be a little limited because I chose forestry. There is one group for starter companies. So if I click on that, what it does is it opens up, it gives me a bit more information about that particular loan or funding. And then it also provides me with the direct link to that program. But like for anything, so here, loans and capital investments, there's loans for women entrepreneurs, farm transfer loan, term loans, business loans. And if it says more, that means there's a few more to show you. It is an absolute wonderful tool on finding all types of assistance for you. This should be also in the kit. If it is not, I will extend it. Oh, do you?
Yeah.
Oh, actually, I don't know that. No, it's not in here, so I'll send that to Grace or Danielle so that we can send that out to you. And then the last thing I wanted to show you is, so if you you've sat here now and you've listened to me, but maybe you have some more questions and would like a bit more information, because in the one-on-one sessions, we go into a lot more information. So if you've decided that that's what you would like to do, on the pamphlet, there is the link. You can also just go in and put in canada.ca/LO help, and it will take you here as well. And right here where it says book a virtual visit or webinars, you just select that. And it takes you to the request form, and then you just start filling it in. What ends up happening is that gets submitted, it will get assigned, and generally, depending on when it happens, could be up to 10 days, but usually it's quicker than that, that we would give you a call back and set something. Okay. Does anyone have any questions? No?
All those things.
You asked all the questions you have, that's great.
So
I have
Karen,
to
you,
get back to
you
on
can,
one.
yeah, you can send everything to me, Karen. It's a lot easier.
Okay,
So it's Grace at Ottawa,
I
hyphen
think
work,
I-
yeah.
I think I have. it.
Everybody has the
Thanks.
same sort of
Yes.
format, yeah.
Yeah.
In terms of the name, so, and then I'll send it to everybody here.
Okay, wonderful. So I'll send you the deck
Sure,
and
then-
the link to that,
that's perfect.
that benefit finder.
Okay, great. Thank you. Well, thank you very much.
Thank you
That
so
was
much.
Thank you very much for coming up.
Thank
you.
All right, and everybody did their survey?
Yeah.
I'll
Very
collect
well.
it.
Thank you. Thank you. Can I just to present a question?
So it was the employees.
Karen, want this? Yeah. Okay, I better turn off the recording.
Yes. Thank you.
Okay, no, it's just.